Welcome to TheoTrade. This is Don Kaufman. Here we are. It's January 3rd, 2018. Tonight, we're going to start with a trade inside of the SPX. Let's get right to it. The hash marks that you see on your screen right here happen to be known as the weekly expected moves. Many of you, if you tune in kind of week to week or even day to day, you'll know that I draw and hand draw these expected moves on your screen at the beginning of each trading week. Well, effectively, if you take a look at the expected moves for this week, and again, these expected moves, what are they? They're derived specifically from the option pricing. Expected move this week was right around the $29 range. So that is effectively, we're expecting about a $29 move higher or $29 move lower. Now, if you kind of want to get in tune a little bit with these expected moves, what you can do, if you are on thinkorswim, you can go to the Analyze tab. Okay, you can cruise over to Think Back, and you can back up the date just a couple of days. Typically, I like to look at the expected moves on a Saturday. So today, for instance, is effectively the 3rd. I can come right back and I can look towards the Saturday, which is again effectively the beginning of each trading week, and that's typically again when I would draw the expected moves. So this week, if I go back to Saturday, you'll see this week we're expecting right around a $29.64 move. Now, all I did is I translated this expected move directly onto the chart. So why do we do that, and what kind of a trade can we build from that expected move? Well, again, I've been tracking these expected moves for pretty extraordinary amount of time. It's actually multiple years. I've been drawing these on the chart now for well over a year by hand. I also have the auto expected move indicator. However, what I want to show you just about the most recent 30 weeks. The most recent 30 weeks, there are approximately 6 breaches of expected move. And all I did is picked kind of an obscure 30-week time horizon over here. And this is, again, approximate. It's about 6 out of the last 30 weeks we had breaches of the expected move. Now, I am actually saying a breach would only be considered at the end of a given week, meaning that there are many times when the expected move has been breached. However, by the end of the week, because this is what we construe as a probability of expiring, that's a probability of expiring inside of a given range, 6 out of the most recent 30 weeks have expired outside of that expected range. So there's about 20% of the time that we're outside of the expected move. All right, with that, let's take you now into this week's expected. So this week, here we are on day number 2. Now we only have a 4-day trading week, right? Because Monday ultimately was New Year's Day. Tuesday, we explode to the upside. Wednesday, we have continuation right now to the upside. But we have breached the upper end of the expected move. And specifically, I can take this down to a 1-minute chart. You can see the expected move is sitting right around 27.03. So what I'm ultimately doing is I'm creating a strategy whereby we believe that we'll be at or under, okay, this level. And again, that level over here would be by the end of the week, and it's effectively 27.03. So we put on a short call spread. Now, it happens to be a bearish trade, but effectively I'm placing the bearish trade not per se because we're bearish, but we believe we're going to be back inside of the expected move. Now, there's very little defense for a trade that's going to be placed with such short duration. Let me go ahead and show you specifically the trade that we built. The trade that we built happened to be a 27.10, 27.15. Now, depending upon when you might have filled this trade throughout the course of today's trading session, and this happens to be a trade that, I discussed in the chat room a little bit this morning. This is a trade that we actually, emailed out, but depending upon when we filled the spread, you may have filled the spread anywhere from $1.50 on up to about, well, right now it's trading in the neighborhood of about $2.20, $2.25. Okay, the fill over here isn't incredibly critical. Like, we have no way of knowing. There's no way of knowing, like, is the market going to continue to breach to the upside over here? when we're outside of the expected move, we know that we have to execute, and we really, at that point, do not want to hesitate, ultimately because we could trade right back inside of the expected move, for example, by day's end. Anyway, the trade that we've created here is a 27.10, 27.15. Again, we're selling the 27.10, buying the 27.15. Now, let's take an assumption here that we just filled this thing for ultimately for $2. Now, how much risk is in a spread? Well, this happens to be a $5 wide spread. The most you can lose in a $5 wide spread happens to be $5, of which we collected $2 up front. So definitive out-of-pocket risk happens to be $3. What we can make ultimately is about $2. Now, that's not half bad when you consider that in the last 30 weeks, over 80% of the time, we've closed back inside of the expected move. Again, there's very little defense for this trade, but I wanted to show you and really kind of lay this out in terms of the probabilities. Just simply a probability-based trade that we're going to sit on, okay? This ultimately, well, we put it on here on a Wednesday. We're going to sit with this trade both Thursday and Friday, see how things play out. Again, as I said, there's not very much defense for the trade. If the market continues to burst to the upside, okay, it's pretty much all over but the crying. The nice aspect is the SPX. The SPX happens to be a cash settlement instrument. So there's no early assignment over here. There's no fear of getting, the SPX called away from us, okay? And in terms of a defensive play, if there's any sell-side activity, really any sell-side activity, later today, Thursday or Friday, it'll give us an opportunity to close this trade literally for next to nothing out there. So that's a trade I wanted to bring into perspective. It's something that we've done frequently, okay, in recent months around the expected move. But again, I wanted to take you a little bit into the probability and that risk reward of that trade. Have a wonderful evening, everybody. Thanks for joining us here at TheoTrade. Have a great night. Bye-bye.